Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to always share evidence-based holistic insights to help you master the game of building wealth. Okay, in today's episode, I want to share an evidence-based approach for constructing a investment portfolio. So constructing an investment portfolio from an asset class perspective, and then even drilling down into how do you construct a portfolio investing in share markets. You know, the thing is, we cannot control returns. Your financial advisor can't control returns. I can't do it. You can't do it. The returns will be what they will be. What we can control as investors is which asset classes we invest in and to what proportions, and what methodology we use to invest and when we invest. They're the only things we can control, and for that reason, that's where most of our energy should be focused on. And if we get those decisions right, in the long run, the returns should be acceptable. In the short run, who knows, right? But we don't need to, worry about that or spend any time thinking about it, because no one in the world has produced some sort of model or theory or way of predicting which asset class will be the best performer over the next 12 months. So you don't need to worry about that. Put that aside. Anyway, that's what today's episode is about, and it's what we call as financial advisors portfolio construction. Now, the general theory around constructing a portfolio is our starting assumption has to be that no one knows what's going to happen in the short term. And I think that's a good, strong, reasonable starting assumption. And so therefore, the idea should be that we should spread our eggs in many baskets, aka invest in many different asset classes. And some are going to perform well in the short term, some maybe not so well. In the longer term, hopefully they all perform well. But by taking that approach, what we're trying to do is reduce the portfolio risk and even out returns. So smooth your returns over a particular time period. But is smoothing returns really that important? Because if my goal is to fund retirement and I'm going to retire in 20 or 30 years, who cares about what the returns are over the next 5 years? Shouldn't your only concern be that by the time they get to retirement in 20 years' time, that my average return over that 20-year period has been acceptable and necessary for me to accumulate the amount of assets that I need? And if that's the case, who cares about the sequence of returns or the distribution of returns over that 20-year period? And so I think, that idea or that thesis, 100%, like who does care? But smoothing returns does add two key advantages. The first one is that life is unpredictable. If there's something that's not going to change itself, and over a few decades, a lot can change in your life, your goals, markets, your family situation, tax laws, your working situation, your income, all those sorts of things. And so smoothing the return profile of your portfolio at least puts you in a situation where it's a lot easier to adapt to those changes. And again, many of those changes are going to be unforeseen. And second, there's a behavioral and a kind of emotional angle to this. So, if you invest all your money in just one asset class and it underperforms for, a really long stretch, you might panic and sell that investment, even though that investment is fundamentally sound. It's just been through an unfortunate sort of flat or depressed cycle. Whereas smoothing returns not only makes us feel more comfortable, so emotionally we feel more in control and safer and those sorts of things, but also we're going to probably less likely to interfere in the investment horizon. And a perfect example of this, by the way, is investment grade older style apartments, particularly in Melbourne. People that have invested in them sort of 10, 12 years ago, they haven't nearly performed as expected. Those assets fundamentally sound. Their intrinsic value is much higher than the market value. They will perform. But, if you buy an asset at the wrong time of the cycle, which in hindsight has been the case, you need to hold an asset for 20 years to enjoy the average returns, or even 25 years rather than necessarily 10 years. So, this one of the key things is market cycles. I've been sort of probably talking more about over the last decade, and kind of the one reason for it. But again, it's a perfect example that is common today where investors are kind of losing patience. And even though the asset's fundamentally sound, they want to make changes and sell the asset. Now, in the blog on the website, I have a chart, and I force my wife to proofread all my blogs that I post on my website, something that she doesn't really look forward to. And she's described this chart as the most confusing chart ever. So I don't want to oversell it, but it is pretty confusing, I guess. Essentially, actually what I've done is I've gone back to 1993 right through to 2024. So it's calendar year. And I chose 93 because that's when superannuation started. And this is how we sort of use this chart mostly. Anyway, what we've done is we've looked at investment returns for a variety of different asset classes. So residential property, Australian shares, US shares, international shares, cash, bonds, those sorts of things. And we've recorded the return for each index in each year. And then we've sorted the returns from high to low, and we've color coded, which asset classes. So for international shares, for example, is in green. And the whole idea of putting all these returns, and of course, the link to the blog is in the show notes as always. So if you want to go and have a look at that chart, it's in the show notes. The whole idea is what the returns have been over the last almost 30 years. Do you see any patterns? And the answer is no. And what it's doing is just underpinning that starting hypothesis, which is no one can predict which asset class is going to perform best over the short term. So therefore, we must adopt a long-term methodology to asset allocation. And that chart is just proof of that hypothesis, really. Okay, so how do we construct a portfolio that is like an all-weather portfolio? That is, no matter what happens, at a portfolio level, we're going to get a positive return, because that's what you'd like to do. And that's what most people would feel really comfortable with, that, you're not going to aim for 20% returns and have huge swings in volatility. But if I can earn sort of 7, 8, 9% per annum each year off my portfolio, I'm going to feel pretty comfortable because I'm making incremental progress towards the end goal each year. And that regular progress makes me feel comfortable. So what we then want to do is develop a portfolio, or construct a portfolio that's going to do that for us. So one of the easiest ways to do that is to invest in negatively correlated assets. And that means when the assets move in opposite directions. So when one rises, the other falls, and vice versa. The most commonly cited negatively correlated asset classes are shares and bonds. Because what happens when a volatility event happens, something that scares the share market happens and risk is off, what typically happens then is investors flight to quality. They want to go to safe assets, safe havens. So they might sell shares and buy bonds. And that's why they typically, historically, mathematically, are negatively correlated. And so the conventional wisdom is to say have 30% of your portfolio invested in bonds and then 70% into stocks or growth assets. However, there's two important observations. So whilst that's true from a portfolio construction perspective, there's two really important observations to keep, not at the back of our mind, in the front of our mind. Firstly, bonds underperform shares, significantly so. So if you go back to 1990, when the Bloomberg Global Aggregate Bond Index begun, it's returned around 3.1, 3.3% over that period of time. So that's nearly 35 years worth of data there. Whereas if you look at global share markets, even Australian share markets over longer periods of time, not the same period of time, but I'm saying long periods of time, they've returned about 10%. So you're going to get a third of the performance if you're investing in bonds. So if you put all your money into shares, you obviously over longer times, the portfolio is going to have higher volatility, you're going to have higher returns. And I return to my original sort of observation, who cares about short-term volatility? The second thing is that the negative correlation isn't guaranteed. And we've been taught this lesson, and it happened in the 70s and also happened in 2022 and 2023, where bonds failed to protect portfolios, largely because, central banks shocked the market when they unexpectedly aggressively hiked interest rates. Of course, that's a very unique situation. It was the end of COVID with a global pandemic. Hopefully that's a once in a lifetime event. So it's not like these things are going to happen all the time, but they have happened recently. And it does remind us that negative correlation is not guaranteed. Happened, I think, in the 1970s when there was an oil price shock as well. Similarly, bonds fell and shares fell in that environment. So if your goal is to maximize long-term returns, which I would argue and hope that most listeners to this podcast, that's their goal, then there's, I think, a strong argument for not including bonds in the portfolio, even though they're going to help you smooth returns. Therefore, if we're going to primarily invest most of our wealth in property and shares, how do we construct a portfolio so that it can thrive in most environments, so that we're picking up positive returns in most environments? And I'm going to come to property, but let's park property for now and just talk about shares. The first thing to recognize is that different rules-based investment strategies, so indexing strategies, perform differently at different times, and they do accommodate different risks and capture different opportunities. And so last week I wrote about momentum investing, and I discussed various factor approaches last week, both value and quality, for instance. So we should start by assessing the risks and opportunities in each geographical share market. We've got to form a view on what those risks and opportunities looks like. So is there concentration risk like in the US stock market? So like I mentioned yesterday, Nvidia now is dominating the market, 8.2% of the S&P 500 index. A company's never held more, one company has never attracted the greatest share of an investment in the history of the S&P 500. So, that's a risk, for example. Is value or growth cheap? And at the moment, value is very cheap, growth is expensive. Is the general market under or overvalued? Are you concerned about, a potential economic slowdown, a recession, these sorts of things? So once we've formed these risks, we can then design a portfolio that best accommodates them. So if I go through some of the sort of indexing strategies that we can use, so if we just talk about traditional market cap indexing, that tends to work like a quasi-growth index because the allocation is linked to share prices. And so Nvidia is a perfect example. When we invest in an S&P 500 fund, 8.2% goes into one stock. And, as share prices, growth prices, accelerate, they start attracting a greater share of that index investing. So indexing, general market cap indexing, tends to work best when the total market is cheap. When you look at, and that's happened at times where you look at the implied multiple in a particular index, PE multiple, and it's cheap, but when the market is expensive, it can be a more risky strategy. Now, I discussed the value factor indexing last week, and that's useful when value stocks are cheap, as they currently are, or when we want some protection against volatility, because the theory is that when markets crash, undervalued stocks will fall less than overvalued stocks, particularly if those stocks are fundamentally sound. So you can use value factor to access those sorts of premia. Quality factor investing, again, I spoke about this last week. This could help you manage concentration risk by using quality factor investing. So, if you're going to have a huge concentration in technology, so at the moment, information technology as a sector accounts for 35% of the index, largest it's ever been. So if we're going to have such a concentration into IT, at least make them quality companies, companies that have low debt, strong cash flows, good dividend flows, all these sorts of things. And so that's the way you can use a quality factor index, is still by following that sort of popular theme around technology and AI. And well, it's popular and it's fundamentally correct, I think. Of course, technology and AI are going to really shape the future and hopefully drive productivity and all these sorts of things. And you can see it in underlying earnings. They are continuing to increase at a fast pace, but at least you can use a quality factor to kind of protect against, some assets or stocks that don't have those fundamentals. You can use a high yield index. Now, the argument around using high yield indexing is that, which means it's targeting a portfolio of stocks in an index that are generating high dividend yields. And the thesis behind that is that if I can bank a yield every year, then I need less growth to justify the overall return. So if my target return is 8% and I'm getting 5% on income yield, then I only really need 3% long term in capital growth to justify the investment. And so that's the argument around high yield index funds. But you just got to be careful, of course. If you've got a high yield, you've got some taxation consequences that go along with it. Geographical market index funds. So if I want to target a particular sector, so if I want to say, well, I want to dilute my US exposure, and by doing that, I'm going to get greater UK and Europe exposure, well, then I can use a UK Europe ETF fund that allows me to tilt my portfolio towards those geographical markets. Again, you'd use that approach if you were concerned about, wanting to dilute your exposure to certain geographical markets. And lastly, you can use listed property and infrastructure. So listed property and infrastructure infrastructure, such as real estate investment trusts or infrastructure ETFs, have some growth and some defensive characteristics. So they're not bonds, but they're also not necessarily like shares as well. They've got some hopefully predictable underlying reoccurring income, and that's sort of the defensive element. And sometimes you want to use that in a portfolio to manage out equity risks, particularly in equity share markets. And so the goal is, as I said at the beginning, identify all the risks and then construct a portfolio that accommodates those risks and opportunities by using a variety of these different rules-based, evidence-based, low-cost indexing strategies. Now, the goal isn't to take massive bets with your portfolio. So you don't want to move too far away from the index in terms of, for example, if you go, well, the US is overvalued, I'm not going to have any US investments. I don't think that's the right answer. I think it's just about saying, well, instead of putting 73%, I think that's general broad index allocation to the US, instead of having 73% invest in the US, I'm going to have 60. So what we're trying to do is tilt at the margins. And then if for my US exposure, I'm going to go some equal weight indexing and some value indexing and some quality, and so that's how I'm going to access the US market. I'm not going to use traditional market cap indexing. But when you look at, it's not a great example, but if you look at, for example, the Chinese market and you look at the implied PE ratio in that market, it's about half that of the US market. So it's cheap. Now, you're not going to use traditional market cap indexing to invest in China. I'm telling you that's not the right approach, but I'm just using it as an example. When the whole market is cheap, you would use probably more market cap indexing. But essentially, we don't want to take massive bets. As I said, exclude the US, for instance, because that's more active investing. And we know when we're looking at active versus passive, we know active doesn't win. Again, no one has a reliable, consistent way of predicting what markets will do in the short term. So we've still got to keep that broad-based exposure, but we can introduce different rules-based strategies to build this kind of all-weather portfolio so that regardless of what happens, if technology keeps rising, okay, I've got some exposure through value and quality, and so that's okay, I can participate in that. But if it all blows up, I've got value and quality that's going to protect me. So what you want to do is build that sort of all-weather portfolio by using those variety of different strategies. Now, the overarching evidence, because it's not my observation or my idea, because it's just embedded in, a very deep body of evidence, is that starting valuations matter in every asset class. So that is, expected returns are heavily dependent on your starting valuation. If you buy very cheap quality assets, you're generally going to outperform expensive and popular assets. Of course, it makes sense that if you overpay for something, that's going to impair your future returns. And so I believe investors need to be, valuation aware. That is always thinking about, is this a cheap asset? Is this a fair price? I don't want to overpay for something. And systematically tilting their portfolio towards, hopefully in fundamentally sound but inherently undervalued assets. Now, sometimes that doesn't resonate with investors because what is cheap is probably unloved and unpopular at a particular time. And everything's popular until it's not, of course. So popularity doesn't last forever, just like sentiment. It will change. And so sometimes, though, people feel more comfortable chasing what's popular. Like growth tech stocks at the moment, for example, you go and buy some NVIDIA, everyone sort of high fives you and thinks you've done a great job. But as I discussed last week around momentum investing strategy, the evidence just isn't there. It doesn't really work. So if my objective, and it is, to maximize long-term returns, irrespective of short-term outcomes, it means that I need to focus on fundamentally sound assets that are historically cheap by long-term historic measures. And again, you're not taking massive bets here. You're not just only investing in the cheapest geographical stock market you can find. It's about tilting at the edges and using those strategies to make sure to avoid the overvalued sectors of the market as much as you possibly can. Now, the other thing to keep in mind when you're constructing an all-weather portfolio, and I borrowed that term from Ray Dalio, who has an all-weather fund, who's a large hedge fund manager, billionaire hedge fund manager in the US. But if you want to construct this all-weather portfolio, you've got to realize you can't completely insulate yourself from volatility. It's actually impossible to do that. And volatility is just a normal part of the stock market. And if you have a look at the last 100 years of data, the stock market crashes by about 30% or more roughly every 7 to 10 years. It's going to happen. Over the next 10 years, we're going to have a crash of 30% or more. It's almost guaranteed, and it should be expected. It's just a normal part of investing. In fact, I saw a chart put together by someone and it looked at data since 1950 in the US, and the average intra-year drawdown. So that means that if I look at, the worst performance over a particular year, the average inter-year drawdown is 14%. So that means on average, your share portfolio will be down 14% during the year at some point. Now, it might end up being the year in a positive return, so it might just be a blip. And a good example of that was what happened in the US market in March and April, when friend Mr. Trump was talking about his tariffs. The drawdown from peak to trough at that particular time was almost 19%. So it happens. But having said all that, year to date, we're up 13.5% in the US. So that's why volatility is normal. It's expected. Instead of perhaps we can reframe volatility. Instead of looking at it as a risk, perhaps we can look at it as an investment opportunity. And, there's that theme of buy the dip, which is, if you do experience a 19% drop, invest at that time. And the people that invested, at the start of April, when it really sort of bottomed out the market, they would have earned a 30% return, so twice as much return. And I think that's probably really the best way to frame volatility is it's an investment opportunity. It's normal, we should expect it, and it's an investment opportunity. And there's nothing you can really do from a portfolio construction perspective to completely insulate yourself from it. When everything is risk off and the market's dropping by 30%, everything falls. But it's really about the recovery and how quick the recovery will be, because the stocks that are completely overvalued and or fundamentally unsound arguably won't recover fully after a volatility shock like that. And we only need to look at a couple of stocks as a good example to that. Remember Peloton, which is a stationary bike manufacturer. At the height of COVID, towards the end of 2020, it was trading at about $160 a share. It's now trading at $7.50. So, there's plenty of examples of these sorts of things that go on. Now, a lot of this research, this asset allocation research, advocates also investing in unlisted investments. So an unlisted investment is obviously by definition not listed on a stock exchange. And so it's a privately held investment. It could be in a property syndicate, it could be in private equity, private credit funds, things of those nature. And they've all had their day in the sun. They've all, gone through significant amount of appeal. Certainly private credit over the last couple of years has been incredibly popular. And the appeal is that, investors can access something that not all investors can access. And you would have realized that I produced an episode about wholesale investing a couple of weeks ago. And that was episode 377, if someone wants to go back and have a look at that. And, because they're not publicly traded, sometimes a little bit opaque, they carry higher risk. And the idea is that investors are compensated for this higher risk. It's often called an illiquidity premium, and it's really just the extra return from not having that liquidity. And there's been a little bit of research by Cliff Annis that suggests the liquidity premium has been somewhat overstated. So maybe the returns just aren't there. The upside of a liquid investments, of course, is that you can't sell during downturns. And that might sound like a negative, but it's actually a pro, I think, because it forces you to ride out volatility. And of course, if the investment is fundamentally sound, then of course it will recover. All markets move in cycles. Of course, the downside is that if it's a liquid, and it is going bad, you can't sell out. And that's a challenge as well. Now, over the past decade, I've invested in unlisted assets, and so have some of my clients. And if I really reflect over the years, I have, reservations whether investors are on the whole being adequately rewarded for that risk. risk. I mean, I think there's a time and a place for them, but I more so over the last decade have placed a higher value on liquidity and also the transparency around openly traded public markets. And I think, be very, very careful, thinking about these unlisted investments, which is not to say that, I think they're all bad and there's not a place for them, particularly if you have a substantial portfolio, but I think I'm less attracted to them today than I was, say, 10 years ago. Okay, so you're going to build a portfolio of shares, you're going to hold some wealth in shares, and that could be inside super, outside super, both of those things. But of course, we've got to introduce other asset classes, and the other major growth asset class there is property. So how does property fit into a portfolio construction? So there was an interesting study relatively recently by Science Direct, and it generally found that there was a negative correlation with share markets. That is, residential Australian property was negatively correlated to share markets, but it really does depend on the time period that you're picking, and some of the data can be a little bit noisy as well. From my perspective, my observation over the last 20 years, I think there tends to be a mild negative correlation with property. So when share markets are underperforming, typically Australian investors do shift their focus more towards property, particularly if at the same time property markets are outperforming. If share markets are crumbling and Australian properties moving forward, typically more money will go into Australian property, and as a result, that's obviously going to drive property prices even further. So I'm not saying that lower share market returns cause higher property returns. There's just a likely correlation rather than causation, of course. So there's a lot of studies around this. So I've looked at the data myself. I think the data is relatively noisy. I don't think we can sit here and say that there's a strong correlator. I think it's either uncorrelated, probably most correctly uncorrelated, and if there is any correlation, it's sort of slightly tilting towards negative. So by employing or including property, direct residential property into your portfolio, you're not necessarily going to create any correlations, but an uncorrelated asset is good too, because it still does provide some diversification. It's just not necessarily going to smooth returns. And I guess property investors, particularly in Melbourne, if you held all your property in Melbourne over the last 10 years, you might have done okay. I mean, depending on the locality and type of property that you've invested, you might have done okay, but haven't done as well as, say, if you had all your property invested in Adelaide or Brisbane, for instance. And so, investors that are in, and even in Sydney, Melbourne and Sydney over the last 10 years, that also had investments in the share market would have seen the benefit of that diversification. Now, of course, there's been periods of time where the stock market's been terrible and the property market's been wonderful, so it's actually turned around. But I think most investors are well suited to holding both those asset classes. Now, I just wanted to offer my thoughts on a couple of alternative asset classes, because a lot of these studies by these academics often include alternative asset classes. Now, they're not going to make a big part of the portfolio. These alternatives might end up being sort of 20% of the overall portfolio. But I just wanted to offer my commentary around this, particularly for Australian investors, and how we acknowledge, I guess, the research and how we build it into our strategies. So the first one is for inflation protection. A lot of these academic asset allocations have an allocation towards commodities and inflation-linked bonds. And this is trying to create some protection against inflation. So for commodities, I would argue that Australian investors don't need more commodity exposure. If you look at the Australian share index, both from a direct and indirect perspective, there's estimated to be around about 40 to 50% exposure to commodities already. So therefore, if you add more commodities into a portfolio that already has a relatively high, say 30 or 40% allocation to the Australian market, I would argue you're probably overexposed to commodities, and therefore I don't think it's necessary. Inflation-linked bonds is when the coupon is linked to the inflation rate. So it'll pay you a coupon, which is an interest rate, inflation rate plus 2%, for example. And we've spoken about bonds at the beginning of today's episode, is just not going to deliver the returns, maybe about a third of the returns of share markets, so we don't need to worry about that. So we don't include inflation protection really in our portfolios. Then there's going to be an allocation towards cash and short-term fixed interest. And in our client portfolios, typically most clients have direct residential property investments, and they'll always have an offset account attached to the loan associated associated with that investment. And if we're going to have any allocation towards cash, that's where it's going to live, in the offset account, because you're going to say the return is really equal to the mortgage interest rate. That's a risk-free return, and it's at call because you can access that cash at any time. So we don't need to build, typically in our portfolios, we don't need to build any cash or short-term fixed interest. And then the other element is duration and credit, and this relates to bonds. And again, the overarching theme on bonds is, you're going to underperform, even though we acknowledge there can be some negative correlation there. So duration, when it comes to bonds, really talks about the time to maturity. And the argument is, typically in investment markets, the longer you lock your money away for, if it's a 10-year bond, you'll earn a higher return. And so tilting towards duration means that you're going to have longer exposure in the bond portfolio, longer duration. And credit refers to the credit quality of the bond issuer. So if you've got an Australian government bond, of course, they're AAA rated, they're very safe. You're not going to earn much of a return because there's not a lot of risk. But if you lend to a listed corporate in Australia through a bond, your return's going to be a little bit higher depending on what the bond is rated at. And that's when you introduce some credit risk into your portfolio. Well, at the moment, there's not a lot of reward for duration. So not interested in that. Whether you're locking for 10 years or, in terms of a bond or a 2-year bond, there's not a big difference in return. So I see no benefit for duration. All you're doing is taking interest rate risk and you're not going to be compensated for it. And credit spreads at the moment aren't too bad, but they're not that attractive. It's not like, oh, wow, that's so compelling. Notwithstanding, I've spoken about bonds in terms of lower overall longer term returns, and so they're excluded from the portfolios from that perspective. But I just wanted to talk about commodities, inflation-linked bonds, cash and short-term fixed interest, and duration and credit, because quite often in these academic studies, they're actually included in asset allocation, and that's why it's really important to have, the experience, I guess, with financial advice and constructing portfolios tells you how to use that knowledge and when to incorporate it, and that's why, just to be from a completeness perspective, I wanted to mention them. Okay, so let's sum it up then in terms of overall asset allocation. How do you produce an all-weather portfolio? So firstly, we believe that most investors would benefit from holding both property and shares. They're the two major growth asset classes. They each have their pros and cons, and at a portfolio level, I think most people will be well rewarded for having exposure to both of those. And when providing financial advice and building strategies, we're completely asset class agnostic. So we don't care about which asset classes. It's really about what works best for the client, their risk profile, goals, and in their particular situation. So when investing in the share market, as discussed, we're going to construct a portfolio to try and manage risk and maximize returns over the longer run. And we're going to do that by using several rules-based, evidence-based, low-cost indexing strategies. For property, it's really about following the 4 golden rules that I spoke about in a recent podcast episode. And that was episode 362. And that gives us a rules-based framework for, investing in property to maximize returns. And then in regards to constructing the allocations to each of those asset classes, typically we focus on property first because it's a lumpy asset. We're forced to invest a lot of money in one hit, and we want to benefit from the compounding capital growth. So typically the first goal is acquire the property assets first. And then once we've bedded down those property assets, that's when we start building out the exposure to shares, either in and outside super, hopefully both of those. Okay, a bit of a longer episode today. Apologies for that. Apologies for prattling on, but I thought it is actually a very, very important aspect in terms of how to construct a portfolio. And I think one of the key things that an advisor can do for you in terms of deliver value, which is a question that I answered in yesterday's Q&A episode, and I probably should have told the listener to listen to today's episode. Hopefully she does anyway. And I thought it was important to spend the time to really unpack it. It's a little bit technical in parts. I hope I haven't confused you, but just generally, I hope you've got a better understanding of, how to approach that portfolio construction question. Okay, that's it for me today. Until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.